on the breakout, gold's going to make a new all-time high.
Gold-backed ETFs in inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
All right, welcome to Live from the Vault. My name is Shane Moran, and I'll be your host for this week's edition. If you're like me and you like silver, you're going to want to fasten your seatbelt. We have Andrew Maguire coming on with some information that is going to absolutely blow your mind. Just before we go to Andy, make sure you hit that subscribe button, hit the like button, and share this information with people that you know, like, and trust. And be sure to download the Kinesis app if you're looking for physical gold and silver that you can even spend on your debit card. Again, no storage fees, and the gold and silver is in your name, in your title. We'll include a link just below here later on. You can go ahead and download that. And so with that, it's my pleasure to go right to talking gold in the UK with Andrew Maguire. Andrew, you have been fired up and busy over the last few weeks. How are you doing there in the UK?
Great to see you again, Shane. And yes, we are. And definitely, there's going to be a lot more. We've got some great information to roll out over the next few days. Watch this space, because definitely there's going to be some interesting people that you're going to want to see that we're going to be talking to. And this is a huge time and a tectonic shift in how we've always viewed gold and silver. So this is exciting. Yeah, nice to see you again, Shane.
Absolutely. Well, Andrew, I'll tell you, one of the, again, most asked questions, we've been talking about this for quite a few editions now. It comes up, it's coming up, but it's still coming up, and it surrounds the question about Basel III being delayed. You previously discussed the fact that this is one of the major drivers for gold and the silver price reset. And so can you just maybe start off this call with an update on Basel III, delayed, not delayed? What does this mean?
Yeah, that's a great question, and definitely many questions around this. There's a lot of confusion about the subject. And I think in our last Live from the Vault episode, what we were trying to do incorporating Basel III, because it is a major component of the gold and silver markets price reset. So what we do is try and present a slightly different perspective, like looking through the wholesale lens, so to speak, to really assist us in tightening up the timelines that lead into an impossible to avert gold price reset. And when we talk about gold, obviously we're talking silver, but in a little while we're going to blow your mind with some information about where silver should be. And obviously we're going to continue to look at this as this all rolls out, but clearly this must begin to unfold a little ahead of the June 28th Basel III deadline. But as you say, there's been so much confusion about the implementation dates of Basel III. I'm going to address them now because it's really important to understand. And what is causing the confusion around the implementation date is that there are a wide range of Basel III compliance standards that actually need to be implemented, some before 28th June and some by the 1st of January 2022 deadline. However, our focus is on the net stable funding requirements, which is the NSFR. And this is the primary gold interbank revaluation component. So when you're looking at these news and you're looking at these reports, remember, that is the aspect that you should be looking at. And while the general rule for full Basel III compliance has been extended to the 1st of January 2022, our focus is on how these rules will still impact the gold markets, forcing the commencement of 3 large gold price revaluation stair steps yet to come. Now, we're just approaching stair step number 1, where gold will be priced significantly higher by the end of the second quarter of 2021. So to be absolutely clear, currently the EU, Switzerland, and the US has adopted and will, as of June 28th, enforce this all-important net stable funding ratio standard, while the UK, has been granted an extension until January the 1st, 2022. But just to put this into perspective, And for the record, there are 62 countries signed up to BIS banking accords, while 10 gold-centric countries are already compliant with NSFR standards. Now, to highlight a few that are already compliant, and I'm not sure everyone knows this, these gold-centric countries are Australia, for example, China, Canada, Hong Kong, India, Indonesia, Saudi Arabia, Singapore. Look, this leaves the UK's LBMA-centric loco London banks offside, as the FSA reports. And the FSA said something along the lines of, due to inflationary feedback on this regulatory change, it may prove challenging to be compliant in time to meet the original June deadline. So that's that. I mean, that's fine, but does that change anything? No, because although every single excuse from Brexit to COVID has been spun to extend this paper gold scam as long as possible, let us be absolutely clear. The 15 trillion, and hard to imagine a trillion, 15 trillion a year over-the-counter gold market expands to a mind-boggling 75 trillion in derivatives. So attempting to unwind trillions of dollars of unbacked, unallocated, fractionally held gold is really an impossible task to complete at, but this is important, at current diluted paper pricing levels. So buying a little time to square the unallocated books of these banks in a more orderly manner, it's not going to delay the gold price reset at all. And as we previously assessed in I think the last 2 episodes, given that physical gold's fungibility, the ability to exchange it anywhere in the world, even as Kinesis does, through the blockchain. But essentially, you can swap a bar of gold from one country to another. It's still the 4 nines bar. It's still the same. The silver bar is the same, and it's fungible. And so really, what we're saying is the primary global physical trading hubs and LBMA refineries are centered in compliant countries like Switzerland, Europe, Asia, Hong Kong, and China and India are also already compliant. So think about this, and that all these market-making LBMA bullion banks have also got physical presence in the EU, Switzerland, Asia. So the LBMA will largely be exposed to these standards by June 28th, regardless. It's just a question of connecting the dots. So these NSFR compliance in these jurisdictions will impact the hundreds of tons. If you remember, you're talking about hundreds of tons of unallocated gold cleared every day by the LPMCL member banks, as we will again today. And to be compliant, though, the London Gold Fix will have to represent a physical price that the LPMCL has to be able to clear amongst this daisy chain of member LBMA member banks. So the resulting price fix will have to be in lockstep with the COMEX futures market price too. So if this price is less, as is the case now, than a physically squared price set by a globally compliant banks globally, it will open massive arbitrage opportunities into a physically starved market, which we know it is. But bear in mind, it's physically starved for one reason, because it's at current diluted, unallocated prices. So only a higher gold price will incentivize more bullion to be put on offer for sale. So absolutely bottom line, the LBMA member banks exposed to EU, Swiss, Asian compliance, they won't be able to shuffle paper market positions for settlement if it's not backed by physical. It only takes one of these daisy chain of LBMA bullion banks to break rank, to short circuit the K-Bow's paper shuffling scam. So even if COVID-19 was somehow to delay full implementation, which I know, which is what people are saying, yeah, but what if it's delayed again? Well, if it is delayed, which is not the case at this time because of what we've just said, because of these other compliant countries, if it is delayed, hey, the cat's out of the bag, guys. And with at least a $500 price anticipated into the second quarter, we're going to see first-tier banks adding to their long books. We have witnessed that time and time again. And it's already obvious that no one is naked short gold for their own book, or silver for that matter, not for their own book. It's already obvious that no one is going to take that risk. Furthermore, if you weigh into this bullish wave that we're seeing now, speculative paper, gold and silver open interest, i.e. what can be usually rinsed out easily, if you can't have anything to cover into, then really you're limited as to what you can sell, because all you're doing is digging a deeper hole. And we see this speculative open interest for people who are long in the paper markets is actually very thin. So very hard to rinse them out. So implementing these NSFR conditions will extinguish and force to market any unallocated gold contracts that are not closed or squared by June 28th. And that's why we've evidenced, this is the reason we're evidencing a scramble by global central banks to repatriate their gold holdings before this date. We've seen evidence of this time and time again, and it's happening every single week and every single month. And furthermore, do you remember in January, following the Scotia-Macota's exit from the very profitable part of their business, which was gold and silver storage, they exited that. And then we reported shortly after that 3 Swiss banks have also moved to comply with these Basel III NSFR standards. And that was UBS. These are whales. UBS, Credit Suisse, also Julius Baer. Look, these banks are no longer going to allow third-party custody. And we're going to see more to follow. So what we're saying is all compliant banks are exiting this business right now. And as we've also assessed the current counterintuitive volatility, as you can see on this chart here, revolves around a scramble to unwind unallocated gold contracts as fast as possible.
Well, Andrew, given the size and the scale of these paper contracts that you're talking about, we're talking trillions. It seems like an impossible task. How do you think that this is going to have to roll out?
Yeah, great question. And I think we did kind of highlight a little of this last episode. Look, the BIS is definitely caught between a rock and a hard place here. Look, this is the equation. Look, you can easily cash settle and bail out all these too big to fail agent banks. And all of these are privileged to have a gold account with the Bank of England. But the BIS cannot risk exposing the massive ETF rehypothecation scam held on the books of these same too big to fail banks acting as authorized participants for these trusts. And if you remember that unallocated gold and silver is the on and off ramp for whether it's GLD, iShares, SLV, those particular, and I'm not saying all ETFs are the same, but certainly those are. So what we're saying is the short-term volatility we are experiencing revolves around the BIS efforts to unwind as many ETF unallocated contracts they can possibly trick out. Now, look, these are large funds who never take delivery, but use these ETFs to track the gold and silver prices. Now, these funds are largely momentum driven and easy to trick out. And the age-old psychological operations, the PSYOPs operations, it employs everything from chart painting, which we just saw, chart painting bearish technicals, and then what you do is trick in momentum-driven technical sellers. These are not physical people. These are people trading a paper price for to benefit from an up or a down price. So, and then what do we see as they're tricking out? But we know from a wholesale market perspective, hey, but this is a strong physical market. So what are you doing? And then, as we evidenced last week, no coincidence, when JP Morgan was wheeled out into a downtrending market just at the right moment to counterintuitively talk down gold, while Goldman's Jeff Curry was wheeled out to actually talk down silver. These are not coincidence. This is part of a psychological operation to actually trick out paper guys, not the physical guys. We view it as opportunities, and I know as you do. So yeah, these footprints tell us though that these same banks are actually going one-to-one long against their client Muppets. And I'm not calling them Muppets. It was, if you remember, Goldman Sachs actually used that term about their clients being Muppets. And what are you doing? You're actually taking the opposite side of what they're being recommended to do. So really the motivation for these counterintuitive efforts is really 100% focused on trying to shake out as many ETF spec longs as possible. That is the only problem at this point, is to try and unwind these massive unallocated positions that have migrated into the ETFs. You can't have an ETF coming into June the 28th with basically rehypothecated gold. It just wouldn't be compliant. So really what we're saying is the efforts for these counterintuitive moves are 100% focused on really just trying to shake out as many ETF spec longs as possible. And we've seen that. So to a large extent, they've already succeeded, but they are pushing the envelope into very thin remaining speculative short cover, which we just discussed. So, and it's important to understand this because that is the picture. So to fulfill their objectives any further, what they'd have to do is run prices lower into a very strong physical market, which would then force futures into backwardation. And we discussed that in prior episodes, exactly how that works. And they push it into backwardation against spot. But what did that do? Triggering the catch-22 arbitrage trade, which is again something we explained in detail in prior episodes. Now, if you remember, this actually happened last Friday night. And in fact, when I say Friday night, I'm talking about midnight on Friday, just when the market's the thinnest. What happened there? We saw a massive down move. And what that did was activate this trade. And there is going to be a price to pay at delivery. And as we discussed in December, the November 2020 backwardations, which was the last time we actually witnessed this event because it's been blocked from happening since then, that resulted in about 10 million of physical delivery demands, which were cash settled for the most part for $40 per ounce, not to take delivery, if you remember. So with the sharks swarming for another catch-22 arbitrage event, insiders managed to avoid placing gold futures into an actionable catch-22 crosshairs until Friday, that is. Now, watch out, because this is actually now playing out. And really, this is a case of be careful what you ask for, because as of last week's gold price smash, it's backfired on insiders. And when you set off a momentum, when you ignite momentum, it can really overshoot. So the full court press commenced with this well-telegraphed chart painted technical so-called death cross, which actually rarely works. But by no coincidence, it was coordinated with JP Morgan calling for a $150 gold crash. Why? Into a strong physical market? This was absolutely blatantly counterintuitive. And how they do it is really just by doing some bid pulling. As a market maker, you're obligated to make a market. You pull some bids, and really you can collapse the market without actually taking creating an unsustainable short position. But you need someone to cover into. But this overshot comfort levels. So what we're saying is last Friday's midnight selling bout, and if you look at the charts, you can see exactly what happened. That was a low. It triggered large spec capitulations from both gold futures, gold ETFs, but it also triggered very large size European, loco London and Swiss bank buying of April GC futures for delivery. Now, as outlined in our December episode, I'm sure it was a December episode, anything over a $2 backwardation, futures discount really, in other words, what we're saying over spot, really is actionable. It covers the 50 cents per ounce delivery cost from the COMEX and all the air freight transportation into Europe. Hey, you don't have to go to a refiner and wait. So at one point, we actually evidenced a $3.50 backwardation. Now, whoever caught that was just laughing. I mean, this is the April contract. I mean, how can you possibly have a cash market trading at $3.50 for an April futures contract? Ludicrous. And it just explains how broken it is. And even worse, though, for insiders, the cost for US bullion buyers to take delivery off COMEX registered inventories, it's way less. They don't have the air freight transportation costs. I mean, we're talking about maybe a buck under spot is probably actionable. I mean, road delivery friction for the US is minimal. It's absolutely minimal. You could probably deliver a ton for somewhere between $200 and $500 or less. I mean, that's really a very small cost. Now, so what we're saying is also, so sharks targeting COMEX registered inventories are not the only risk, though, for the house. And we are absolutely certain, and we've said this before, and we are absolutely certain from a wholesale market perspective, that central banks and sovereigns are busy bolstering their balance sheets ahead of Basel III gold revaluation as a first-tier asset. And it's prudent for all the BRICS countries, the Brazil, Russia, India, and China, to secure as much physical gold as possible into a rapidly debasing US dollar at gold prices estimated by all the first-tier banks to be at an absolute minimum of $2,500 right now.
Well, Andrew, well, I'll tell you, since 2021, there's been a huge spotlight on silver. Maybe you can update us on how all of this will impact the silver market.
Yes, I knew you'd want to know that. Shane, you're one of the largest silver guys I know. And I mean, yeah, let's actually start with the elephant in the room then. SLV. Now, we've talked about it many times, but trading banks are actually spooked by BlackRock's admission that they may not be able to fulfill the SLV baskets. And there was an announcement made, as we know, it's been a couple of weeks old now. And they're saying that, look, we can't fulfill all these SLV baskets with wholesale 1,000-ounce bullion bars. This is an unprecedented condition and presents a major red flag, and it really has freaked out the banks. The physical silver short squeeze is no longer viewed as a retail shortage. There are simply not enough wholesale bars to meet global demand, but this is the key, at current prices. And that's where the battle line is. It is at current paper diluted prices, not the price of silver, but what it is being offered at. So bottom line, there's plenty of wholesale 1,000-ounce standard bars to supply to really fulfill every incoming SLV buy order. But for this to occur, the price would have to be significantly higher. So if the price of silver was allowed to reflect true global supply demand fundamentals, when you've got literally thousands of tons being requested to come into the SLV, these are purchases, they would have to be bid at least at $30 to $40 per ounce for offers to sell, to rise to meet this current bid demand. So you'd have to chase that price, i.e. you start putting orders into the market for more than even the largest bullion banks hold. You would simply, no one's going to offer it to you at that price if you start coming in for that kind of size. It'll simply raise the offer. So, I mean, look, it may even be higher as offers to sell really dry up in a rising market. It makes sense. I mean, of course it would. So just look at the short squeeze in platinum. That is just a perfect example. It's a small market, and you can see what's happened. It is a supply squeeze, and it's a short squeeze. So look at the platinum chart. This is yet to come for silver, but silver even more so. So right now, every single ounce of SLV demanded could be easily fulfilled in allocated form at a true supply-demand global wholesale offer price. And this is the most bullish setup in silver since June 2010. And really got to remind you what happened then. Back then, silver was really almost exactly $10 below current levels, which is, I'm just looking at 17.3-ish, somewhere around there. And it rose almost without pause into the 1st of May for a gain of $32.50 per ounce, went up to 49, just short of 50. Now, this rally point was the last time we evidenced this is important, it's not just ordinary backwardation. We're talking about forward market to spot backwardation. But even more bullish, with a silver short squeeze in the crosshairs of a very dedicated group of Reddit physical silver buyers, we like to call them raptors. Physical shortages and premiums are even more pronounced than they were back in 2010. Now, last Friday's overnight spike bottom was a classic capitulation event. In a paper market, you need a spike. It just won't happen unless there's a spike. But I mean, we even telegraphed that insiders would actually have lost money and precious COMEX inventory if the price had remained under 27, which is why we telegraphed that whale-sized buyers at this level were going to absorb all the offers should it be offered at that price. So while options resistance really at the same time is starting to evaporate around the 29,750 level, which is beginning to look a little magnetic. Now, obviously, we got first notice day today. You have volatility around. You had more calls than puts expiring. You've got disruptive rollovers going on. You know, expect volatility. It's this paper market, but they're not going to take a short position. So, in the related and much larger gold market. And it's important to cover this because we also have similarities to June 2010, in so much as refiner rationing and shortages for large size at current prices are evident, but don't be fooled by retail bullion being available at close to spot. Unlike June 2010, the paper to physical backwardations are actionable because it exposes COMEX registered inventories to real physical delivery demand, unlike then, when everything was able to be squared without the sharks circling. And so if you're weighing Basel III, NSFRs, and the time and incentive, the timeline and incentive to cover massive short GC and gold futures and unallocated over-the-counter positions, it's even more critical than we experienced in 2010, when GC rose, and gold futures or gold rose in general terms, $750 into September 2011. So with so many specs wrong-footed and the commencement of this move looks imminent, we've reached a tipping point where in order to balance the books, central banks ultimately need a higher gold price. And this is also going to impact silver.
Now, Andrew, earlier, you had mentioned in our conversation that you had some mind-blowing silver expectations. I know that all of our silver fans out there, and there's a lot more coming. Can you share with them what you're seeing and what the good news is for the silver stackers?
Yeah, Shane, and let me just tell you, I do have a pulse, and I haven't been, the lockdown hasn't addled my faculties. I'm being very conscious about what we're about to talk about. One of the, I know you're one of the strongest private silver stackers I know. And in a minute, I am going to blow your mind with, and I haven't actually given you this price yet. So I wanted to save it for this episode, but I am going to blow your mind with the price targets for silver. But to do so, we just have to look at the gold market for just a second here, because Basel III and Basel IV addresses, this is the key thing, a major imbalance, and that is gold's collateralization of US foreign obligations. Now, this is a percentage. This has reached historic lows, and under the covers, this is one of the main objectives that Basel III and Basel IV is going to be forced to address. Now, we see this as the primary reason that gold must be revalued. Now, the current ratio of gold to foreign debts outstanding is just as tiny as about 6%, right? 5-6% right now. Now, Luke Groman, who I totally respect, drew my attention to this important metric. And he pointed out that this ratio actually, and he's correct, should historically revert to a minimum of about 20 to 40%, somewhere between those parameters. Now, this puts gold right now, today, at around $6,000 to $12,000 per ounce. But even more dramatic than that, The last time the US dollar was questioned was in 1980. And we remember what happened. I'm sorry, a lot of you guys probably weren't even born then, but I mean, this was the last time we really saw the US dollar question. And when the foreign held treasuries of the US governments at that time were actually at 140% collateralized by gold. So if we were to say that happened again, and why wouldn't it? At 1980 levels, that puts gold at $43,000 an ounce. Now, no, I haven't gone crazy. Those are legitimate drivers. And we don't know what's going to happen to the dollar at this point. There's a scramble. So where does that put silver? This is it. This is where I'm going to give you the numbers. At 60 to 1, which is kind of where we are now, that puts, without even adjusting for anything, that's $95 to $190 silver. However, if you were to look at the same situation as the dollar and the 1980 levels for the dollar, this would potentially put silver at a gobsmacking $680 per ounce. And however, as gold breaks loose of its unallocated collar, silver will too. Actually, this puts silver closer to the historical 16 to 1 level, because the only reason it's not at 16 to 1 is because it's been diluted by massive amounts of paper silver. So put a short squeeze on silver and the ratio becomes magnetic. So silver's 2023 price potential is $375 to $750. And if the dollar fails, and brace yourself, it won't be gold called at $2,500 an ounce. In a free market, it will be silver at $2,500 per ounce. Hey, why not? Question yourself, why not? We are in unprecedented times. We have a broken banking system. So don't discount these unprecedented circumstances. Basel III seeks to address this global imbalance by devaluing unallocated gold or silver into a high risk weighted, and it's gold really that's going to be, unallocated gold that's going to be weighted into a third tier asset, as low as it can go, while physical gold side of it morphs to a first tier asset. So Basel III will stair-step gold higher into the much more aggressive Basel IV standards coming into force by 2023. Now, I will look closer at Basel IV next time. If unchecked, this is actually going to be a tectonic event that will knowingly bankrupt some commercial-facing first-tier banks, as well as many second-tier banks. Now, making it almost impossible to have enough cash reserve to actually loan money to businesses, which is ominous. So by January 2023, though, looking at gold, it'll have to be trading between at least 10,000 and 15,000 per ounce. So pretty much those are my projections.
Wow, now Andy, you got me all fired up here about the gold and silver, but more particularly about the silver and the potential that it has in store moving forward in the next years ahead. This is amazing. Thank you so much for sharing that with me. There you have it, Talking Gold with Andy Maguire out in the UK. And I just want to remind everyone as we conclude here to subscribe, like, and share this information. Hit the bell notification so you can be notified as these editions go live. And also, one more thing. If you would like to see guests, we're going to be bringing on more and more guests in the future moving forward. Comment below on who you would like to see on Live from the Vault, and we'll do our best to bring those guests on moving forward. So with that, we will see you next time on Live from the Vault. Bye for now.